Candlestick patterns only work if you apply this one technique. Most traders memorize shapes, slap them on any chart, and wonder why they keep getting stopped out. You're about to learn how to read candles in context, where they form, what they confirm, and how to turn them into actual entries that pay. Let's get into it. Before any pattern, you need to read one candle. Two shapes on screen: bullish in green, bearish in red. The thick part is the body. It shows the open price and the close price. On the green candle, price opened low and closed higher. Buyers won the session. On the red candle, price opened high and closed lower. Sellers won. The thin lines above and below the body are the wicks, also called shadows. The top of the upper wick is the high. The highest tick the price reached. The bottom of the lower wick is the low, the lowest tick. 4 numbers per candle: open, high, low, and close. A long body with tiny wicks means decisive movement. A small body with long wicks means both sides fought hard and neither won. Patterns are just specific combinations of these shapes, repeating because human behavior repeats. Now let's go through the 5 patterns that matter most. A doji is a single candle where the open and close land at almost the same price. The body is tiny. Neither buyers nor sellers won the session. The long upper wick shows buyers tried to push the price higher and got rejected. The long lower wick shows sellers tried to push the price lower and got rejected too. Total indecision. By itself, the doji means nothing. Where it appears is what matters. After a strong uptrend, it signals the rally is exhausted. After a strong downtrend, it warns the selling is fading. Always wait for the next candle to confirm the reversal before you act. Here is a real doji on Apple's daily chart. First, the context. Price has been falling for 10 sessions. Selling pressure is starting to fade. Then it prints a candle with almost no body and long wicks on both sides. Buyers and sellers fought to a draw. The very next bar closes green. That is your confirmation the trend has flipped. Entry buy on the open of the bar after the green confirmation. Stop loss goes just below the doji's low. That defines your risk. Target the next major resistance above. One more rule: dojis only matter at extremes. A doji in the middle of a range tells you nothing. That's just normal indecision. Wait for a doji after a strong move. The hammer is one of the cleanest reversal patterns in technical analysis. Small body near the top of the candle. The close lands right near the open, sometimes slightly above. Tiny upper wick. Almost no buyers got rejected on the upside. Long lower wick, and this is the key. The wick should be at least twice the size of the body. The story: sellers pushed price way down during the session, but by the close, buyers absorbed all that selling and drove the price right back up. The lower wick is the proof. A hammer at the end of a downtrend is your highest conviction bottom signal. Entry on the next bar's open. Stop loss just below the wick's low. Tesla on the daily. A real hammer in action. First, the setup. Price has been falling for 10 sessions, dropping nearly 30 points. Then it prints a candle with a long lower wick. Sellers pushed price down hard, but buyers absorbed it and the close lands back near the open. Notice the wick is more than twice the size of the body. That's the threshold. Without that ratio, it's not a real hammer. Entry on the next bar's open. Stop loss just below the hammer's wick low. That's your defined risk. Target the next major resistance level above. Volume matters too. The hammer bar should print on above average volume. Heavy volume means real buyers stepped in, not just a quiet drift back up. The shooting star is the mirror image of the hammer. Same logic, opposite direction. The long upper wick is the signal. Buyers pushed the price way up during the session, but couldn't hold it. The small body sits at the bottom of the candle. By the close, all those gains evaporated. Tiny lower wick because sellers never gave buyers a chance to push down. The story: an uptrend made one last attempt to push higher, then ran out of steam at the top. Sellers stepped in and slammed it back down. Same threshold as the hammer. The upper wick must be at least twice the body. Entry: short on the next bar's open. Stop just above the wick high. Microsoft daily. A textbook shooting star. Price has been climbing for 10 sessions, gaining over 30 points. The trend is strong, but it's about to break. Then the candle prints. Buyers pushed the price up by $7 intrabar. Then sellers slammed it all the way back down. The close lands right near the open. Long upper wick, small red body. Short on the next bar's open. Stop loss goes just above the shooting star's wick high, your defined risk. Target the next major support below. Just like the hammer, volume confirms the signal. A shooting star on heavy volume means institutional sellers stepped in. A quiet shooting star is much less reliable. Saw that setup play out in real time. Good. Pattern 4 is the one that catches most traders off guard. Pay attention. Bullish engulfing is a two-candle pattern. It signals a sharp reversal. On day one, a small red candle. Selling pressure is still in control, but it's weak. The body is small. On day two, a large green candle. Its body is so big that it completely engulfs the previous day's red body. Open below the prior close, close above the prior open. The story: yesterday's sellers were ambushed. Today, buyers showed up in force and overwhelmed them in a single session. That kind of shift in control usually means more upside is coming. Trade rule: enter long on the next bar's open. Stop loss below the green candle's low. The bigger the green candle relative to the red, the stronger the signal. Here is a real bullish engulfing on Nvidia's daily chart. Price has been drifting down for 9 sessions, selling pressure but losing momentum. First, a small red candle prints. Sellers are still in control but barely. Then the next day, a huge green candle opens lower and closes way above the previous day's open. It completely swallows the small red body. Entry on the next bar's open. Stop loss just below the green candle's low. That's your defined risk. Target the next major resistance level. The size ratio matters. A green candle that's 3 or more times the size of the red is a strong signal. Roughly equal sizes mean less conviction. Quick pause. If this is clicking, drop a comment below telling us which topic you want next, and smash the like button. It genuinely helps the algorithm push this to other traders who need it. Now back to the lesson. Bearish engulfing is the mirror of bullish engulfing. Same logic, flipped. Day 1, a small green candle. Buyers are still in control, but the body is small. Momentum is fading. Day 2, a large red candle. Its body completely engulfs the previous day's green body. Open above the prior close, close below the prior open. The story: yesterday's buyers were ambushed. Today, sellers showed up in force and overwhelmed them in a single session. The control of the chart flipped. Sellers now own it. Trade rule: enter short on the next bar's open. Stop above the red candle's high. The bigger the red candle relative to the green, the stronger the signal. Meta on the daily: a real bearish engulfing. Price has been rising for 9 sessions, gaining roughly 25 points. Buyers are in control, but the momentum is slowing. Then the pattern prints. A small green candle, then a huge red one that opens above the green's close and slams down to close well below the green's open. The red body fully engulfs the green body. Short on the next bar's open. Stop loss above the red candle's high. Your defined risk. Target the next major support level below. Volume confirms the signal. Heavy volume on the red engulfing candle means institutional sellers committed. Light volume means it might be a fake out. Wait one more bar for confirmation in that case. 5 patterns, 1 framework. Doji is indecision. Only matters at the end of strong moves. Hammer is a bottom signal. Long lower wicket support means buyers stepped in. Shooting star is a top signal. Long upper wicket resistance means buyers ran out of fuel. Bullish engulfing flips the trend up. Yesterday's sellers were overpowered today. Bearish engulfing flips the trend down. Yesterday's buyers got ambushed. 3 rules apply to all 5. 1. Confirm with the next bar. 2. Size the trade based on volume. Heavy volume validates, light volume warns. 3. Place your stop at the pattern's extreme wick so risk is always defined. That's candlestick patterns. 5 shapes that tell you what buyers and sellers just did, and what they're likely to do next. Master these 5, apply the 3 confirmation rules, and you'll filter out most of the noise on any chart. If this helped, drop a like, and follow at nytradestudio for the next lesson on chart patterns, the larger structures that hold dozens of candles inside them. Keep your charts clean and your stops tight. See you in the next one.